Okay, we're going to go through the recording of purchasing this $5,000 inventory with 2% discount if paid within 7 days. We're going to use the net method because companies really should not miss discounts. If they do, they're essentially passing up good money, because you'd have to borrow at a rate of more than 36% per year to say, oh, well, it's not worth paying, or not worth paying in 7 days to get this 2%. So anyways, how you go about recording using the net method is that you assume you're going to pay within the discount period. So you're going to debit inventory, debit what you get, for the 5,000 times 98%, which is that 2% discount. So 4,900, and then you're going to credit accounts payable. Now, then you've got to pay for the shipping. That's a separate entry because it's to a different party. So you're going to add that to your cost of your inventory, because all costs to get your inventory in place and ready to sell would be part of your asset. And then what you're going to do is probably credit cash or maybe a payable to the shipping company. Now let's go with what happens if they didn't pay within the 7 days. How it would have to be recorded then is that you're going to end up having to pay the full 5,000, excuse me. But here's the thing: is you can't debit these accounts payable for more than what's in there, so you'd have to debit the accounts payable for the 4,900. Now if you see, we're off by 100, and that we're off by 100 on the debit side. What we're going to do is debit this discounts lost, and that basically is a shame on you, accountant. I shouldn't have missed that. So that's how that's done when you record using the net method for purchases. Let's look at, though, from the seller's perspective here. I'm going to make up a little bit of a different problem here, where you have, let's say you make a sale to your customers where it's $2,000, okay, and you credit your sales for $2,000, and then when you record that, you've also got to reduce your inventory, and let's say the cost was $1,500, so you're going to then debit cost of goods sold for $1,500. Now, as far as if you pay, or if your customer pays within the discount period, what you do here is the gross method, because we want to, as a company, see what is the cost of this sale. So if the purchaser pays within the discount period, you're not going to get the full 2,000. You're only going to get 1960 in this example that I have here. This is the same one that's in the textbook. Okay, so that you have 2,000 was the price, but then you got here we had a 2% discount. The purchaser had a 2% discount. So you can see now that our cash we're getting is $40 less than what our receivables are. Well, you still have to credit your receivable for that customer. You have to clean that customer's account out, which you put the full amount in. So you have to credit 2,000. You can see we're off by 40. That's going to go to sales discounts. So sales discounts is called a contra equity account, excuse me, and it gets netted against your sales. So when you see an income statement and it says net sales, it's discounts being netted against that. So you can see our sale amount will be just the 1,960. But for internal purposes, it's good to keep track of how much are these discounts truly costing us. So the methods are done differently depending on whether you're the purchaser or the seller. I hope that helps.